Bankruptcy. Here we are in a downturned economy. Well, it often happens. Our case today involves bankruptcy. Involves a situation where somebody went out sometime before the recession developed and they bought a car. They went in, $30,000 automobile, they put down $4,500. They traded in their old car, but their old car still had a loan outstanding of $22,000. At the end of the day, when the dust settled, they wound up borrowing $35,000 to buy a car worth $30,000. They were upside down when they first made this purchase. Well, they declared bankruptcy. And one of the things that they did was argue essentially that the guy that gave them the loan can't have a claim that's larger than the value of the property. Basically what they're saying is the car was worth $30,000, I borrowed $35,000, the most you as a creditor can get back is $30,000 because that's all the car was worth when I bought it. Well, the bankruptcy court heard this and they said, well, wait a second, no, that isn't the case. You volitionally entered this deal, and under the current regulation, the guy that gave you that loan, the company that gave you that loan, does have a right to the full $35,000. Went up on appeal. And on appeal, the appellate court held the same thing. That even though the car was only worth $30,000, the person who had borrowed $35,000 was at an obligation to pay that full $35,000, granted being reduced in bankruptcy by a number of other things. But the point of this is very simple. If you go out, buy a vehicle, or buy some other property, but particularly buying a vehicle, and you borrow more than the vehicle is worth, and you're upside down right off the bat, that's going to haunt you as long as you owe money on that car. All right. Well, not good news for many people, but we bring you the law as it exists so you can understand the law. My name's David Allen.